Good morning, everybody. As Jackie said, my name is Andrew Mosley. I'm one of the directors at MetaPraxis. I've been with the firm for about 25 years, so I've seen the whole evolution of management information through from the early stages of executive information through business intelligence and now into big data. Just a few words about MetaPraxis. Our mission is to help our clients make better decisions faster, and that echoes some of the words in Jackie's presentation. We do that by specializing in visual planning and analysis, and this concept of visualization is very important to what we do. It's really at the core of the spirit of the company. And to deliver that, we develop specialist software. We have a package called Empower, which will form part of my presentation later on. And we also have a team of financially qualified consultants who work with our clients on joint projects to improve the business control cycle within their organization. Our clients are all large organizations, FTSE 350 companies and equivalent size businesses across multiple industries. Now, I mentioned the business control cycle. This really is the fundamental methodology that we adopt. And it's really about, what are the stages that you need to go through to improve the performance of your business by taking more effective action to improve the future. So measurement is an important part of that. Measurement has advanced considerably from the early days, 25 years ago, when the objection to working with us was often, well, I just don't have the data to answer these questions. Now we've moved through that. People have built ERP systems. They've got good consolidation systems in place. But the challenge now is to actually complement that data with meaningful external data and non-financial data that can provide a more complete picture of business performance and actually help answer what the key business questions are that need to be asked by the board, by executive managers, and by line managers throughout the business. But just measuring that data isn't enough. The next step is actually to analyze it and find messages which then deliver insight which is actionable, which can be converted into action. And that process of converting insight into action involves dialogue typically between finance, between the FP&A function, for example, and line management. Because finance alone cannot really take action to improve the future. You have to get the line people on side. So visualization is at the core of what we do, and we use it because we believe it's a really strong tool for communication, for enhancing understanding, and for performing analysis. And it does this by developing representations of data that reveal things that you wouldn't otherwise be able to see with the naked eye. And in the context of big data, that's about transforming schedules and tables of numbers into insightful graphics which communicate insight, and do so in a way in which the human brain can easily understand those messages. And this definition of visualization is one which was written by a designer of infographics, actually, called Alberto Cairo. But I find it a very helpful crystallization of the key benefits of visualization, both within business and in other applications. And the reason that visualization is so powerful is that it connects with the human visual system. And our visual system, it turns out, is a pattern seeker, a very, very powerful pattern seeker. And so often we're involved with clients designing dashboards and designing management information delivery. And what's important then when you're designing schedules and designing visualization is to realize that that process of visualization doesn't just happen on the page or on the screen, but it happens in the viewer's brain. And there are certain psychological techniques that we can use to actually enhance the digestion of that information. And one example here is an example that Stephen Few uses in his books and in his presentations, which is to start really with a lot of numbers there, a jumble of numbers, it appears, but often that's the way management information appears to the reader when it's presented as a schedule of numbers. Buried in this schedule are the number 5 appears many times, but to actually search for those 5s is quite a difficult task. But if we apply a visual technique, such as using colour, and we colour all the 5s red, we can easily see them. So a very simple example of how you can use some visual techniques, in this case called pre-attentive processing, to find messages in data. Another example is of using colour here is, we've got a sea there of red dots, but the thing that our eye, I think, is drawn to, or our brain is drawn to, is the green dot, the exception. And using colour intelligently to highlight messages and to highlight exceptions is a very important technique. So it turns out that this process called pre-attentive processing that happens in our visual system is a very automatic, effective, and effortless way of digesting information, which is why we believe visualization is so powerful. And the benefits then are that we can use our visual system in parallel with other parts of our brain to digest and analyze data. We can use visualization to filter out noise by, for example, sorting and ranking, to recognize patterns in data, like correlations and trends, to follow lines of thought through dashboards, which maybe start at answering a top-level question and then drill down and slice and dice through the data to follow a particular train of thought. And I'll give you an example of that a little later. Visualization is a fantastic way of identifying, spotting exceptions, and also for perceiving the unexpected. So that's back to Jackie's point about using tools that enable us to almost find the questions that we hadn't already asked. So the process and the methodology that we go through with our clients in terms of revealing what the data has to say is to really start by articulating the key performance questions within the business. Most of our projects start at board level or divisional level beneath a group holding company, but at a senior level. And what we tend to do is start by building a business driver diagram with our clients, which articulates a chain of cause and effect, which is the sort of mental model about the business. From having identified what those key performance questions are, we then look at what data is available within the business and actually understand what are the questions that could actually be answered from the data that we have. And that's not just internal data, but it's data that's external to the business or non-financial. So, for example, it could be market share data or market data that we collect from other sources like Euromonitor or Nielsen. And the kind of questions that we can answer by integrating that with financial data are powerful. So it's all about finding the data you already have and using relevant analysis techniques to answer the key questions about the business. So our approach is very much start with what you have, with what's available, before you start to look outside of that and take the next step in the big data journey. We believe that you can do a lot with what you already have and what's already available. We work across multiple industries, so we work in financial services, and some examples of visualization that we've developed there. We did a project about 18 months ago to work with one of the very large UK-based banking groups to build a prototype group risk dashboard that incorporated data around credit risk, market risk, and operational risk at group level, which enabled risk managers to understand and build out the risk of the organization. We've done a lot of work in retail and consumer products in terms of understanding sales and margin trends, and in the retail space, some innovative analysis around product affinity. And in technology, we have a client where we help them inform the board around the products and customer life cycle to understand the key the key trends in terms of customer dynamics and product dynamics, so that they could make decisions about where to invest their capex to get to harness the next wave of technology. So, in terms of revealing business messages, there are 3 techniques that I wanted to talk about today and give you some examples of. And these are simple techniques that can be really applied using data that already exists in organizations. The first is variance analysis, which is designed to answer the question, why have things turned out differently, and what are the root causes? Secondly, iceberg analysis. That's the term that we've developed for finding hidden variances that are down in the depths of the data, which may be obscured by compensating favorable variances. And thirdly, sales pipeline analysis, which is around identifying what the risk is within a sales forecast by incorporating data from our CRM systems, for example, Salesforce.com, with our financial revenue forecasts. So to take each of these in turn, variance analysis. To be effective, analysis really needs context. You need to be making a comparison between what you see and what you expect, or what has happened in the past. And variance analysis is really a statistical or mathematical technique to enable that to happen. It enables us to break variances back into their constituent parts. So, for example, if we look at a sales variance, we can break that back into components such as price variance, volume, and mix. Now, this is a technique I think that accountants are frequently taught, but doesn't turn up too often in business, actually. I think people forget how to do it. They did their accounting exams, and then they sort of move on, and they think it's a little hard to explain. But actually, it's a perfect methodology to use for very, very large data sets. You can use it with any kind of trend-based data. So if you don't have a budget or forecast, it doesn't matter. You can use the variance analysis to compare a current month's performance against previous months or against last year, for example. And the whole technique isn't limited to financial data. You can use it with non-financial data as well. So it's a very robust and generic technique that we can use across business. So to give you a simple example, I think we all know revenue, we can break down into price times volume, but that's not the whole story. If you've got a multi-product business, for example, here we've got a business selling 2 types of fruit, apples and bananas, and we're looking at comparing performance in 2013 against the previous year. And we can see at the total level, the volume of products hasn't changed between those 2 years, but there has been a change in revenue, and therefore a change in the average price across those products. And as we look into the detail there, we can see the reason why. We sold twice as many apples in 2013 as in 2012. The prices remained the same, so we've got twice as much revenue. Bananas, on the other hand, we sold half as many bananas as the previous year at the same price, so our revenue from that source has halved. But because those products are sold at different prices, when we come to aggregate that data and then calculate the weighted price, we can see that our weighted price has moved from 37 pence in 2012 to 23 pence in the current year. So, if we were just to look at variance as price times volume, we would miss this whole mix effect that's been going on between the apples and the bananas. Because both our products have shown a change in volume. So we need to actually take that change into account. And we can do that by 3 different types of calculation. The price variance we can calculate easily. It's just the difference between the unit price between last year and this year times our current unit volume. Similarly, the volume variance is quite easy to calculate. That's the difference in unit volume between the 2 years times last year's weighted price. The mix variance is a little more difficult to get your head around, But what you find is that the calculation on the screen there is the correct way of calculating it, and it means that the overall sum of those three variances is the overall variance at the top level. So the effect of those calculations on our very simple data set there is that we can see there's no price variance because at the product level we've maintained our selling prices. So the price variance that we saw by doing it simplistically has now gone away. We have a volume variance at product level, but that cancels out at the total level. But a mix variance, which is really the most important thing going on in this set of data. The mix variance is larger for apples than bananas, and the total of those two variances accounts for the difference in revenue that we see between the 2 years. So this type of technique we use extensively. We're working with a financial services client which has a very, very large volume of transactions. I think it processes several million direct debits every year, and it's the UK's largest financier of insurance premiums. So it finances insurance premiums, things like school fees and other annual payments, and sells that business primarily through a range of intermediaries, insurance brokers and the like. And the business is really interested in understanding changes from quarter to quarter, month to month, in the mix of its business, in the loan rates that it offers its intermediaries, and in other factors such as the size of loans that are being made, which also affect the pricing. So this type of bridge chart analysis, breaking down variances into rate, loan band mix, client mix, division mix, and volume variance, is very important in communicating both upwards to its private equity owners and also a tool that can be used within the business to have a more constructive dialogue with the sales function and enable the salespeople then to go and talk to their intermediaries, to their brokers, and ensure that appropriate action is taken to drive performance in the right direction. Second technique, which is related to variance analysis, and I'll show you examples of both of these in a moment, is what we call iceberg analysis. And that is the fact that if you just do a simple top-down analysis where you drill down through variances, you can often miss major variances which may be adverse variances that are compensated for by positive variances at the same level. And that's important because you can find that the underlying data may be wrong. It may actually hide a miscoding of the data, or it may be a real variance that really needs to be followed up. So we've developed a visualization technique that we call iceberg analysis that reveals the hidden hazards beneath the surface. And what I want to do now is give you